Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. This is the Deep Dive, where we take a stack of articles, research, and notes and really try to extract the most important nuggets of knowledge and insight for you.
That's the goal.
Today, we're diving into, well, quite a collection of financial magazine headlines and market reports. We've got stuff from CNBC, Bloomberg, Yahoo Finance, Reuters, all updated as of today, Monday, August 11th, 2025. Our mission is really to go beyond those headlines, help you connect the dots, understand the core drivers behind what's moving global markets.
And those key economic decisions, plus some, frankly, surprising corporate news.
Yeah, definitely surprising.
Exactly. We'll be looking at everything from, say, looming tariff deadlines, the future of AI, all the way down to, like, the practical impact of that new tax break for tipped workers. It's really about cutting through the noise, finding what truly matters.
Okay, so let's unpack this. There's a lot happening that could significantly impact your world, from the biggest geopolitical plays right down to your everyday wallet.
Global market tensions and economic policy shifts.
All right, let's start with the big one, these ongoing trade tensions. They're clearly influencing global markets. Reports from CNBC show Asia-Pacific markets trading, well, a bit subdued today. What's the immediate trigger there?
The immediate trigger, and what's really fascinating here, is the intense focus on that looming August 12 deadline for the U.S.-China tariff truce.
Ah, right. Tomorrow.
Yeah, exactly. Investors are basically holding their breath, just waiting for an official announcement on whether that truce gets extended. We are seeing China markets open marginally higher, which sort of signals some hope for an extension. And Morgan Stanley even suggested, according to CNBC, that the Hong Kong market could regain some significant momentum once there's more clarity.
On the U.S.-China trade relations, especially with China's next 5-year growth plan coming up.
So it really shows how tied market sentiment is to these high-stakes talks. Absolutely. It's all deeply intertwined.
Okay, but beyond the U.S.-China dynamic, we're seeing tariffs impacting other economies, sometimes in unexpected ways. For instance, Yahoo Finance and Bloomberg are reporting on this new 39% tariff imposed by U.S. Customs and Border Protection on certain Swiss gold bars.
Right, specifically the 1 kilogram and the 100-ounce bars.
Exactly. But here's where it gets particularly intriguing. There's apparently significant ambiguity around whether this applies to the more common 1-ounce gold bars. What does that ambiguity mean for the market, for investors?
Well, that ambiguity is critical. Scott Travers, he's the editor-in-chief of Coinage magazine, highlighted this to Yahoo Finance, and it's fueling a lot of speculation.
I bet.
Yeah. While gold prices did initially surge on the news, his advice was basically against speculative buying or selling. He sees gold more as, insurance or maybe a currency for emergencies. So the takeaway here is that even targeted tariffs can create this widespread uncertainty. It pushes investors towards a kind of wait-and-see approach, and it raises this important question about how widely these tariffs will ripple. Not just their gold markets, but maybe other commodities seen as safe havens too.
Speaking of ripples, Goldman Sachs economists seem to be ringing some alarm bells. Bloomberg reports they're predicting that U.S. consumers are going to bear an increasing burden of these tariff costs. They forecast that the consumer's share could rise from, an estimated 22% right now, up to 67%. That could potentially push the core PCE index, that key inflation measure, to 3.2% year-on-year by December. That's up from 2.8% in June. That's a huge jump.
It is.
What's a practical implication for us, for consumers?
Well, it's a direct hit to household budgets. I mean, if we connect this to the bigger picture, it really underscores how tariffs directly contribute to inflation. And it's not just the direct cost of imported goods either. As Yahoo Finance details, domestic producers, shielded from competition by tariffs, they can also opportunistically raise their prices.
Okay.
So the real takeaway here is that while tariffs are often framed as a tool for protecting domestic industries, a significant chunk of the cost ultimately gets passed right onto the consumer, makes everyday goods more expensive.
So we'll get more clarity on Tuesday with the July CPI report, the Consumer Price Index. Economists expecting headline inflation to rise to 2.8% annually.
That's the expectation, yeah. We'll be watching that closely.
Okay, so all this inflation talk brings us right to the Federal Reserve. Markets seem to be pricing in several interest rate cuts this year. There's even a new nomination to the Fed board, Stephen Miran, which Yahoo Finance suggests is fueling predictions of sooner rate cuts. Is the market getting ahead of itself here?
Well, that's precisely the Fed's dilemma, isn't it? Richard Bernstein, the CEO of Richard Bernstein Advisors, highlighted this in a Yahoo Finance interview. With some Fed officials already dissenting on holding rates steady, he poses the challenge. Can the Fed actually cut rates without signaling that the economy is weakening? So much so that people shift from, speculating on things like Bitcoin
Right.
to just buying essentials like, quote, bread.
That's a tightrope walk.
It's an extremely delicate balance. They want to avoid recession, sure, but they also can appear desperate. That could spook markets even more. So while rate cuts might sound appealing for borrowing costs, the why behind them is going to heavily influence market reaction and, consumer confidence.
And Bitcoin is certainly part of that speculative surge. According to Bloomberg and CNBC, it's hitting within striking distance of a record high, over $122,000. Meanwhile, Ether soared to its highest since late 2021, topping $4,300. Why this massive crypto rally now, especially when traditional markets are so sensitive to tariffs and inflation?
It's a fascinating dynamic, really. Bloomberg highlights that strong demand from institutional investors and also corporate treasury buyers is fueling this rally.
Right.
And Fundstrat's Thomas Lee, in a CNBC interview, he noted Ether's appeal to Wall Street, citing its zero downtime since inception and being the most legally compliant and secure blockchain.
Interesting.
But what makes this particularly interesting in our current discussion is that crypto is increasingly seen as this borderless, tariff-free store of value.
Bypassing the trade issues.
Exactly. As gold faces its own supply bottlenecks and these new policy risks with tariffs, digital assets offer an alternative that sort of bypasses those traditional trade barriers. It's a fundamental shift, maybe, in how some investors are thinking about hedging against economic uncertainty.
Tech, AI, and innovation in the spotlight.
Okay, let's shift gears. Moving from macroeconomics to the world of tech, it seems the Magnificent Seven trade, those big U.S. tech stocks like NVIDIA, Microsoft is once again the most crowded trade. That's according to a BofA survey cited by Reuters. And chip makers are certainly making headlines with some pretty wild developments.
Oh, indeed. What's truly fascinating are the developments around NVIDIA and AMD. The Financial Times, this was covered by CNBC, reports this unprecedented arrangement.
Unprecedented how?
Well, these two chip makers will apparently pay 15% of their China chip sales revenues directly to the U.S. government.
15%, wow.
Yeah, in exchange for export licenses to sell specific chips, like NVIDIA's H20 and AMD's MI308 in China. This follows President Trump's earlier threat of a 100% tariff on semiconductors unless companies build in the U.S.
So this is different than a tariff.
Right. The core insight here is that this isn't just about tariffs. It's almost like a new form of geopolitical leverage, essentially taxing chip sales as a condition of market access. It fundamentally reshapes how tech companies have to operate across borders.
And just when you think you've grasped that, here's where it gets really interesting. Chinese state media, affiliated with CCTV, has accused NVIDIA's H20 chips of being a national security risk, claiming they're not technologically advanced, not environmentally friendly, not safe, and could even have a remote shutdown backdoor. That was widely reported by CNBC.
Yeah, quite the accusation. NVIDIA strongly pushed back on those claims, stating, quote, NVIDIA does not have backdoors in our chips that would give anyone a remote way to access or control them.
Okay.
But this tension just perfectly highlights the ongoing semiconductor export controls between the U.S. and China. I mean, even though NVIDIA resumed H20 sales after a previous ban, remember, these chips were developed as a less advanced option specifically for the Chinese market because of earlier export restrictions. CNBC detailed that background.
So the takeaway for us is,
the takeaway for you here is that technology, especially these advanced chips, has become a central battleground in a much broader geopolitical struggle. Both sides are using various means from tariffs to, state-sponsored accusations to exert influence and control.
right. Meanwhile, other chip makers are seeing a different kind of surge. SK Hynix shares rallied. They forecasted a robust 30% annual increase in demand for high-bandwidth memory HBM chips. Those are essential for AI, right?
Yeah.
Through the end of the decade. That's according to Reuters and CNBC.
Yes, HBM.
What does that tell us about the future of AI investment?
Oh, it's a very clear signal. It tells us that the major cloud providers, Amazon, Microsoft, Google, are significantly increasing their capital spending on AI infrastructure. That directly benefits the HBM market.
So the hardware side is booming.
Exactly. The insight for the listener is that this AI revolution isn't just about software, it's heavily reliant on the underlying hardware. This huge demand for HBM indicates a fundamental sustained investment in the core components that actually power advanced AI.
And speaking of AI, SoftBank founder Masayoshi Son. He's making his biggest bet yet, aiming to place SoftBank right at the center of the AI revolution. He's even predicting artificial superintelligence will be, get this, 10,000 times smarter than humans within a decade.
A very bold claim.
Yeah, reported by CNBC. Okay, let's unpack this a bit. SoftBank has made massive AI plays already, acquiring chip designer Arm, which is now valued at over $145 billion, planning billions in investments in OpenAI. But given SoftBank's, let's say, past experiences with some splashy tech bets, is this truly different?
That's the crucial question, isn't it? Sun's vision, as CNBC details it, has actually been brewing for over a decade. He had early bets on things like brain computers and humanoid robots like Pepper.
Right, I remember Pepper.
Yeah. And while some of SoftBank's earlier large investments in tech, like, say, ride-hailing companies, they certainly face challenges, timing issues, significant losses. Sun believes it's still very, very early in the AI investing cycle.
So he sees this as a different wave.
He sees this as a Cambrian explosion moment for AI, a fundamental shift, unlike anything before. That's the core insight. However, the critical challenge, and this was acknowledged by Morningstar analyst Dan Baker in CNBC's reporting, is whether SoftBank can actually outpace disruption.
Disruption from who?
From new players,
Where?
like the Chinese firm DeepSeek, which recently developed a reasoning model more cheaply than its U.S. rivals, even despite export restrictions. This just highlights the intense global race for AI dominance and the constant threat of new, agile competitors popping up.
Diverse corporate moves and consumer realities.
Okay, moving beyond the big tech battles and geopolitical chess games, we're seeing some unexpected strategic moves from major companies. Elon Musk's Tesla, known for EVs, has formally submitted a request for an electricity license to the British energy regulator, Ofgem. CNBC reported this. What's behind this? Pivot into energy supply.
It's a fascinating strategic pivot for Tesla, yeah. And it's likely much more than just a side venture. If they get approved, it could allow them to directly compete with established UK energy firms, sort of like their Tesla Electric service back in Texas. And the timing is interesting. This move comes when Tesla is enduring a pretty protracted EV sales slump in Europe. New car sales dropped nearly 60% in the UK, 55.1% in Germany in July compared to last year. That's according to CNBC.
Wow, that's steep.
It is. They're facing stiff competition from Chinese EV makers and also some reputational damage from Musk's rhetoric. So the insight for the listener here is that companies like Tesla are constantly looking for new revenue streams, ways to leverage their brand and tech in adjacent markets, especially when the core business faces headwinds.
So it's not just about selling cars anymore.
No, it's about building an entire energy ecosystem.
Okay. And we're seeing other significant corporate moves around the globe, too. For instance, Chinese vaccine maker AB Biotech saw its shares surge, incredible 160% on its Hong Kong trading debut. CBC reported that.
Yeah, huge debut.
While Chinese battery producer CATL had to halt production at a key lithium mine after its license lapsed. And SoftBank, again, making moves on the IPO front, selecting banks for a potential U.S. IPO for its Japanese payments app, PayPay. That could raise over $2 billion later this year, according to Reuters and CNBC. These really paint a picture of highly dynamic global markets, wouldn't you say?
Absolutely. These diverse corporate stories really reflect the rapid shifts and the localized challenges within the global investment landscape. AB Biotech's surge highlights the appetite for new biotech ventures in Asia.
Right.
While CATL's production halt underscores the regulatory and resource access challenges, even for industry leaders, and PayPay's potential IPO, that's a signal of SoftBank's continued strategy to monetize its successful ventures, even while it's making these new, bold AI bets.
So the collective insight.
The collective insight here is that even amidst broader economic trends, these individual corporate stories, especially from emerging markets, can present unique investment opportunities and risks. Based on very specific local conditions or strategic plays, you can't paint everything with the same brush.
Okay, all of this brings us to something that directly impacts many people, especially those in the service industry. President Trump's recently signed No Tax on Tips bill. CNBC detailed this one. This big, beautiful bill provision offers a deduction of up to $25,000 for qualified tipped workers. It phases out at $150,000 in adjusted gross income, and it's temporary, just 2025 through 2028. But as one bartender noted to CNBC, it feels kind of too good to be true. Is there a catch?
There absolutely is reason for that skepticism. This raises an important question about clarity and, the practical reality versus the political promise. While it does reduce federal taxable income, workers are still likely paying state taxes and federal payroll levies for Medicare and Social Security. Ben Henry Moreland, a certified financial planner, pointed this out.
Ah, so it's not no tax, just less federal income tax.
Exactly. Furthermore, there's significant ambiguity around what exactly constitutes qualified tips and how employers need to report them. For instance, do automatic service charges, which often get mixed in with other tip income, do they actually qualify?
Good question.
Yeah. The insight here is that while the bill aims to provide relief, the actual benefit for workers could be significantly less than the headline figures suggest, just due to existing tax structures and, frankly, a lack of clear implementation guidelines right now.
And this comes at a time when consumers are actually tipping less. The average tip in Q2 2025 across restaurants, cafes, bars was down to 14.99%. That's according to Square's report cited by CNBC. There's also this growing tipping fatigue, right? 41% of Americans saying tipping is out of control in 2025. That's up from 25% last year, according to a Bankrate report also mentioned by CNBC. So is this tax break just arriving at a really challenging time for tipped workers?
It's a very complex situation because even with a potential federal tax break, the reality on the ground for tipped workers is shifting pretty dramatically. Industry professionals, talking to CNBC, explain that this is influenced by, well, evolving consumer sentiment, higher service costs impacting diners, and generally smaller check averages these days.
So the tax break might not offset the overall trend.
Exactly. The overall takeaway here is that while the no tax on tips provision sounds beneficial, it might offer fairly limited relief against these broader economic pressures and changing social norms that are already reducing tipped income for many. It's really a reminder that policy changes often intersect with and are sometimes even dwarfed by existing market forces and consumer behavior. Outro.
Wow. What a dive. From the intricate dance of global tariffs and central bank dilemmas to the bold bets in AI and the everyday realities of tipped workers, it's clear that the world of finance is incredibly interconnected and just constantly evolving.
Indeed. And if we try to connect this all to the bigger picture, it's really about recognizing how geopolitical strategies, these massive technological breakthroughs, and even subtle shifts in consumer behavior, how they all converge to shape our economic landscape. Each of these stories, whether it's, the future of AI or the price of gold, is a crucial piece of that puzzle.
Absolutely. So what stands out to you from today's deep dive? Maybe consider how these seemingly disparate headlines might actually be part of a larger evolving narrative. A narrative about how global powers and technological innovation are reshaping both markets and, well, everyday life. We'll see you all tomorrow morning with new headlines from major financial magazines.